Stocks continue to struggle with the American president's mixed messages on tariffs. If you're looking for more consistency, you may find it in AI-associated stocks. Let's bring in Justin Elliott, portfolio manager at Caldwell Investment Management. Thanks for joining us.
Great to be here.
How much damage is the continued uncertainty around tariffs doing to, you think, earnings estimates?
Yeah, when I was on about a month ago, 2 months ago, we said that we had expected elevated volatility under a Trump presidency, and nothing's really changed there. Investors don't like uncertainty. Company management teams don't like uncertainty. And that's been a big issue over the course of Q1 earnings, right? A lack of visibility into the rest of the year and going forward as a result of some of those tariffs. And so management teams are pausing investments. They're unable to give guidance in a lot of scenarios, and that makes it a lot trickier for analysts and the investment community to kind of put some numbers around how they expect the year to be. So, all of that leads to elevated volatility, and that's why we kind of see these rapid swings on days when Trump is announcing stuff as he is today, even example for copper and other areas of the market. So definitely makes things a little more challenging.
So earnings are one thing. I'm wondering about the actual market, because it seems like investors are really starting to shrug off the tariff announcements at this point. If they are reacting, it's minimally.
Yeah, I think a while ago, people had come up with the acronym for that taco trade, kind of Trump always chickens out. And that's part of the volatility, the uncertainty. He'll come out, he'll announce tariffs, and he'll walk them back, sometimes as much as same day, but perhaps next day. And so that makes it really hard to kind of gauge how serious he is when he says these threats. Now, 90 days have passed. We haven't really gotten any sort of deal in place. I think he's perhaps getting a little bit more frustrated. And the fact that the markets have rallied to almost all-time highs here give him a little bit more leeway in that he grades himself on how well the economy and the market's doing. And so he can, throw out these wild numbers. And I think he's willing to take a little bit of the pain of the market selling off before he, potentially redacts this time. But it seems like he's willing to continue discussions if other countries are negotiating in good faith. And so we just hope that, deals will come sooner rather than later, and we'll get a little bit more certainty on how things are going to proceed going forward.
Okay, let's talk about AI a little bit, because I'm wondering if you're seeing businesses convinced about the benefits of getting AI and putting it to use and returns on AI spending.
I think absolutely. Around 40% of U.S. enterprises today have some sort of paid AI subscription, and that's up from 30% from the start of the year. And so we're really starting to see an acceleration here in the adoption of AI, consumer and enterprise use cases. I think we hear it every week, right? A lot of these layoffs are being driven by AI, more so right now on the software side. I think it's helping programmers become more efficient, but it's also reducing the need for some junior level programmers as well. And so I think that's helping drive, cost cuts. It's helping drive that ROI. And for the price you're paying right now for some of these AI agents and access to these AI models relative to salaries that are out there, I think companies view that as a good return and a good substitute. And so, we think the enterprise adoption is going to just continue to ramp from here.
Okay, so I think that answers the next question, because there are fears of a bubble, right, in comparison to the dot-com bubble. Do you see that right now?
We see a couple key differences. And first is really the success and kind of the efficiency and how quick a lot of these AI-related companies have translated that AI into actual revenues and profits. So even if you look at the large labs like OpenAI, right, going from $4 billion in run rate revenue at the start of the year to around $10 billion today. Anthropic from $1 billion to $4 billion. The profitability outlook is a little bit longer down the road, but on the public side, you've got the cloud players that are already capitalizing and are profitable on a lot of this AI revenue. And so we see it's not just vanity metrics this time around, it's real revenue, it's real profitability. And we still are very early days in terms of that kind of penetration runway. And so we think that continues to play out here. That's one key difference. The second would just be overall valuation levels. And so if you look at sort of the tech sector today, trading at 30 times earnings, which definitely is expensive to the market, but nowhere near the sort of 40s and 50s that you saw back in the 2000s. You had a lot of companies trading at 100 plus times earnings. That was very commonplace back then. And so you have valuations that are much more reasonable in comparison today. And those are some of the key differences that we see between now and then.
All right. I do want to get to your first stock pick, which is associated to the AI ecosystem, Vertiv Holdings. Why Vertiv?
So Vertiv is a global leader in tech hardware that helps manage power and heat distribution in data centers. They derive 75% of their revenue from data centers. Obviously, there is a huge global build out of data centers. It's the critical backbone for running AI. Lots of sovereign nations around the world see the benefit of having AI in their control on their ground. And so you see just a huge proliferation of AI buildouts going on around the globe. That for them is translated into very significant growth in their backlog, as well as visibility well beyond a year out. They talk about customers wanting to lock in orders for 2026, 2027 even. And so we really like that visibility, right? Especially in a market like this where things are very, very volatile and, the tariff question is always up in the air. We also have seen very strong margin expansion from Vertiv. So as they sort of scale up, as they improve their production processes, we've seen those margins improve. And lastly, we think they've been cleaning up their balance sheet as well, aiming to sort of get and maintain that investment grade credit rating, which we think will be beneficial for the stock going forward, allow them to issue debt if they'd like to do acquisitions, that sort of thing. So I think it's a really good stock. Yeah.